Thanks everyone, and thanks to Tanya for hosting this masterclass for us. I will, of course, let you spearhead the conversation. And just a little bit about Tanya Wadhwa. She's having almost close to about 8+ years of experience, currently a manager with KPMG, taking a lot of these masterclasses here in applied finance. Also, one of the most liked trainers that we're having over here, I must say that. And she's having a smile on her face.
I wasn't aware of that. So,
like I said, I'll let you spearhead the conversation, and we're really looking forward to the entire masterclass.
thanks, Neerja.
Over to you.
Hi, everyone. How are you? How's everyone doing? So, before I start, I would actually like to ask everyone just a quick question as to because there are around 74 people here, so I can't speak to everyone individually, though I'll try to. But anyone from a non-finance background? Non-finance, non-commerce? You can speak up or you can write in the chat box. I'm watching that as well. Okay. Abhilash, I think you are from a non-finance background. Bharat, you are, and Nandita, you are. Okay. So the thing is that you might feel that whatever I'm teaching today is a little like a little confusing, or I might be going too fast. So if you have any questions, you can stop me and I'll address the queries right there and then. So today we'll be covering three, like we'll be doing an overview of three main topics that are also a part of our course, which is the Companies Act, the like an overview of Indian accounting standards, and Schedule 3 to the Companies Act 2013. So before I actually share my screen, I would like to make this as interactive as possible. So, can anyone help me with why companies are required to prepare financial statements? What is the reason? Like, why is it a requirement? Why do we see every company preparing financial statements? Anyone who wants to take this up? Okay. So, most of you, like, this is like a part of the answer where you're saying that to know the financial health, someone is saying it's a legal requirement, someone is saying it's a regulatory requirement. Okay. So I'll park the answer for that in the next, like I'll answer this in the next 10 minutes, what I was aiming at. All of you are correct, but that one particular answer that I'm looking for, I'll just address that in 2 to 3 minutes. Another question that I have is why are companies required to appoint internal and statutory auditors? Does anyone know why do we see every company having a statutory auditor? Some companies also have internal auditors. Why does that happen? Corporate governance, maintain uniformity in reporting, check status, make sure authenticity. Again, all of you are correct, but I haven't got that one answer that I was looking for. So every question that I'm going to throw at you in like the next 3 or 4 questions I'm going to throw at you is going to have the same answer. So let's check the next question. So during COVID, you would have seen that some companies were donating heavily to the Prime Minister's Relief Fund. A lot of heavy donations were going in. Why was like the answer to that is common with the first two questions that I asked. Why was that happening? CSR is correct. CSR is a part of a major act. Does anyone know the name of that act? Improve goodwill. A lot of you said CSR. So the people who said CSR, can they help me with the name of the act to which CSR belongs? The Accounts of Companies Act 2013. Correct. Okay. One last question before I end the question that I'm asking. So, like if I talk about Gillette India, the razor company, it's actually an American company. Something even I found out today morning when I was prepping for this session. So, Gillette India is actually preparing its financial statements in India as well while being an American company. Does anyone know why that is happening? It's a foreign company, yet it's preparing its financial statements in India. Or a company like Tesla, which is not based out of India. Okay, someone is saying operating in India, Companies Act. Okay, so yes, all of you are correct. So actually, the reason why this happens, why everything just boils down to the Companies Act, is because Companies Act actually forms the basis for everything that we just spoke about: preparation of financial statements, appointing internal auditors, appointing statutory auditors, donating to the PM Relief Fund, which most of you answered correctly, that was CSR. By foreign companies like Gillette India, though it's an American company, is also preparing its financial statements in India. So everything actually boils down to the Companies Act 2013. The Companies Act 2013 is an act which is required to be complied with every company that is operating in India. So this could be an Indian company. This could also be a foreign company having its operations in India either through a branch or through electronic mode or through an agent, which is why we see companies like Gillette, which is actually based out of America, preparing its financial statements in India. There is a company like Tesla, which is a foreign company looking to open a branch in India, is not required to prepare its financial statements in India because it hasn't started its operations here. So when I talk about the Companies Act, this lays down the base and everything else follows. So an example of the things that I spoke about: preparation of financial statements. So every company in compliance with the Companies Act 2013 is required to prepare its financial statements. And financial statements would contain of the balance sheet, the statement of profit and loss, statement of change in equity, statement of cash flows. So this is a requirement of the Companies Act, which is why we see every company preparing financial statements. Another thing that we see, which I think some of you answered, that we were preparing financial statements to comply with accounting standards. This would actually be surprising, that because one would think that compliance with accounting standards is something that comes from the central government or maybe comes from the ICAI. It does, but the base of compliance with accounting standards actually first falls in the Companies Act 2013, which says that every company complying with the Companies Act is also required to comply with accounting standards. Another thing that the Companies Act 2013 lays down the base for is the accrual basis of accounting. Can anyone help me with what the accrual basis of accounting is? Also for our non-finance friends here. Yashwant, Kailash, if you can help me with what is the accrual basis of accounting? Correct, correct, this is right. Can any one of you speak up, and if you're comfortable doing that? Okay, so accrual basis of accounting is actually a fundamental accounting concept which is required to be complied with. But another surprising fact is that accrual basis of accounting is also laid down by the Companies Act 2013. It says that every company complying with the Companies Act 2013 has to follow the accrual basis of accounting. So, what is the accrual basis of accounting? Say I am incurring an expense. So, I have a factory and the factory has 12 months rent. I'm talking about April 21 to March 22 financial year. So there is a 12 months rent, and obviously we would be paying the rent in the subsequent month. So for the month of April, the rent will be paid in May. For the month of May, the rent will be paid in June. So since when I'm talking about the month of March 22, where the rent has still not been paid for that month, it will be paid in April 22, which is falling after the financial year. Will I be recording that rent for the month of March in the same financial year, or will I be taking it forward and recording it in the next financial year? So the accrual basis of accounting says that expenses have to be recorded on an accrual basis, that is to the period to which they pertain, and not on the basis of payment. So rent is actually a classic example, and everyone has answered correctly. Rent is actually a classic example of where a situation where the accrual basis is followed, and this basis has to be followed for every expense or revenue that is recognized in the financial statements of the company. And another example, sale of goods on credit, very good example of accrual basis of accounting. So where revenue expenses are recorded on an accrual basis and not on a cash basis. Again, Companies Act 2013 says that every company complying with this act has to prepare its financial statements on an accrual basis. Another requirement of the Companies Act 2013 is compliance with Schedule 3. We'll just understand what Schedule 3 is, but to quickly address it right now, Schedule 3 is the statement which prescribes the format of presentation of financial statements of a company. In which order should the financial statements go? Will the assets come first? Will the liabilities come first? Where will the equity sit between assets and liability? So the format or the guidelines for presentation of financial statements is given in Schedule 3. So Companies Act 2013 is actually telling us to do all of these things. It is saying that if you're a company complying with this act, prepare your financial statements. If you're a company complying with this act, you comply with accounting standards while preparing your financial statements. You also follow the accrual basis of accounting. Your financial statements have to be prepared on an accrual basis. And you also comply with the Schedule 3, apart from other requirements, obviously, which we'll just see. But these are some things that are actually coming from the Companies Act. And this lays down the base, and everything else that we see in the financial statements of any company are flowing from the Companies Act 2013. So another fact that I would like to tell you is that when a company is preparing its financial statements, it is required to prepare an accounting policy section. So right at the top of the accounting policy section, where the company talks about its background, it also tells you that the company is complying with the Companies Act 2013. So that is something that is explicitly written in every financial statements of any company. Any doubt so far? Yes, Bharat, you're right. Insurance premium is also done with accrual basis. Yeah. Non-finance people, if you have any doubts, please tell me. So let's see some of the other requirements of the Companies Act 2013. So this I spoke about right in the beginning of this section, provisions related to CSR. So actually the Companies Act 2013 lays down certain rules and certain guidelines. If a company follows, like if a company falls within those guidelines, that is, if it meets certain paid up share capital, certain turnover or profit requirements, then it is required to donate 2% of its net profits to CSR. Now, when I'm saying donate to CSR or corporate social responsibility, I mean that there is a schedule called Schedule 7, which is there in the Companies Act 2013, which lays down a list of activities that if you do these activities, you are actually complying with your CSR responsibilities. So that schedule covers activities like donating to the PM Relief Fund, contributing to rural development projects, contributing to any slum development project. So if we see a lot of companies donating to PM Relief Fund, yes, it's a way of goodwill, like someone correctly said, but also it is a CSR responsibility. They are required to compulsorily donate to these funds or to these activities to comply with the Companies Act 2013. So this is one requirement of Companies Act 2013, which we see very often. For second example that I stated right in the beginning was appointing an internal auditor. Can anyone tell me what an internal auditor is? How is he different from a statutory auditor? Manisha, you were asking what is CSR. Your friends told you that it's corporate social responsibility. To put it in very layman terms, it is donating to certain activities, donating to certain funds which are prescribed by the Companies Act. So if we do that, we are complying with our CSR responsibilities. So coming back to the next question that I had asked, who is an internal auditor? How is he different from the statutory auditor of the company? Yes, Khushi, you're right. Correct, Sai, that's correct. So an internal auditor looks at the internal controls, the financial and operational aspect of a company, whereas a statutory auditor actually looks at your financial statements, whether they are giving a true and fair picture of the company. All of you are correct. So appointing an internal auditor is actually a requirement of the Companies Act. So listed companies and some unlisted companies, if they meet certain turnover, paid up share capital requirements, etc., are required to appoint an internal auditor. This is something that comes from the Companies Act. So if you are a listed company, or even if you're an unlisted company and you have a certain turnover, certain paid up share capital, then you're required to mandatorily appoint an internal auditor. We would also see that some companies haven't appointed an internal auditor. This might be an unlisted small company which hasn't met those requirements. So the third requirement of the Companies Act is filing of financial statements. What do I mean when I'm saying filing of financial statements?
Probably at the end of it, all the financial statements that have been recorded by the auditor, more like all the work that the internal auditor did throughout the year, compiling it all in cash flow and the turnover ratios, everything.
Hi Ria, which question are you answering? I'm so sorry.
So filing the financial statements, I mean, not in the exact filing part of it, but yeah, that makes sense.
Okay, thanks, Ria. Thanks. That was helpful. So actually, my question was, if you only can take it up, was that what do I mean when I'm saying, like, if I say that I have to file my financial statements, where are these financial statements being filed?
In India, at least as far as I have read, that I think we have to submit the financial statements to the registrar of the companies.
Absolutely correct.
The
The financial,
MCA.
right, right. So the financial statements have to be filed with the registrar of companies within a certain time limit. I won't go into the details because that will be like an overload of information. But filing of financial statements is again a requirement of the Companies Act. So if we say that a company has filed its financial statements with the registrar of companies, this is a requirement that comes from the Companies Act 2013. Another thing that is Companies Act 2013 is circulation of financial statements. So, what do I mean when I'm saying circulating the financial statements of a company? Zubia said,
To the board of directors, to investors, to multiple people whom it actually matters, to stakeholders. Yeah.
correct, absolutely correct. So, yes, it will be circulated to the shareholders, stakeholders, eventual trustees, public investors. All of these answers are correct. So, yes, the financial statements of a company have to be circulated to all these identified people. But again, this is actually a requirement of the Companies Act. Why we are circulating financial statements? It's because the Companies Act 2013 tells you to circulate these financial statements. Another thing that comes from the Companies Act 2013 is components of financial statements. So, can anyone help me with what are the components of the financial statements of a company? What do I mean when I say components of financial statements? How many components are there? Are we saying balance sheet, P&L, cash flow statement? Correct. Yeah, cash flow statement. All of you got it correct, except we are missing two statements. So, notes to account. So, we got the fourth one. And what is the fifth one? There are five, right? So Bharat got the fifth one, statement of changes in equity. So there are actually five components of financial statements. So Companies Act 2013 says that when you're preparing your financial statements, you will have five components. First is the balance sheet, which tells you about the financial position of the company. That is the position of its assets, of its liabilities, of its equity. Second is the statement of profit and loss, which tells you about the financial performance. How has the company done in that financial year? What profit did it earn? What loss did it make? What was the revenue? What were the expenses? So that is what the statement of profit and loss tells you. Third is the statement of changes in equity, which is like a tabular representation of our equity share capital and our other equity. So when I say equity share capital, that is what were the changes in the equity share capital during the year? Were there any shares that were issued? In case of other equity, which would basically be retained earnings, reserves, and surplus, what were the changes due to profit, due to distribution to shareholders? So that will be covered in the statement of changes in equity. Fourth is the statement of cash flows, which tells you about the liquidity position of the company. That is, when we look at the profit and loss statement, that tells you about the profit, but it also has some non-cash elements. So what the cash flow statement does is it removes those non-cash elements. That is something maybe depreciation, which actually is a non-cash thing. Even some income items which are actually not generating any cash, but they are lying there in the profit and loss account. So we remove all these non-cash elements, and that leaves us with the actual cash position of the company, which is actually looked at by some of the stakeholders of the company. And the fifth component of the financial statement is the notes to accounts, which would include the accounting policy, like the guidelines or the rules on the basis of which the financial statements have been prepared. It also gives you the breakdown of every line item in the balance sheet in the statement of profit and loss. That is, if I talk about the property, plant, and equipment of a company, what all does it include? It includes the leasehold improvements, it includes furnitures and fixtures, there's plant and machinery, what is the depreciation expense for the year, was there any impairment? So it just breaks everything down, and that gives us a notes to account. So components of financial statements, the fact that these are the five components of financial statements, that is again coming from the Companies Act 2013. So the Companies Act 2013 says that every company will prepare its balance sheet, its statement of profit and loss, statement of cash flow, statement of changes in equity, and the notes to accounts. Any questions so far? This was a little finance heavy. So if the non-finance people have any questions. Statement of changes in equity. Yes, I spoke about that. Devyansh, can you explain filing? Filing of financial statements you're talking about? There's the first question first. Statement of changes in equity tells you about the changes in equity, that is the equity share capital and other equity, which includes reserves and surplus during the year. So if we are comparing two financial years, how did the equity position of the company change from the beginning of the year to the end of the year? So that is something that is summarized in the statement of changes in equity. And Divyansh, filing of financial statements is that basically once you're done preparing your financial statements according to the timelines that are there, these have to be filed with the registrar of companies. This is a requirement of the Companies Act 2013. So another requirement is applicability to foreign companies. So this I spoke about right in the beginning, that a company like Gillette, which is an American company, is preparing its financial statements in India. Similarly, a company like Tesla is actually not required to comply with Companies Act 2013. Why is this? Because as per the Companies Act 2013, any foreign company having a place of business in India, either through an agent or physically or through an electronic mode, that is a company that conducts business in India, is required to comply with the Companies Act 2013. So this is a requirement that is there. Now, non-applicability to certain companies. So actually the Companies Act 2013 extends to the whole of India and also to foreign companies like we discussed before, including banking companies, insurance companies, government companies. But there are certain aspects that are there in the Banking Act or the Insurance Act that override over the Companies Act in case they are in conflict. So this is another requirement of the Companies Act 2013, that every company in India, including banking company, insurance company, is required to prepare the financial statements according with Companies Act 2013. But it is also required to comply with its specific acts that are there: Banking Regulation Act, Insurance Act. So another requirement of Companies Act 2013. So let's just quickly look back. We saw that Companies Act 2013 is actually the base for everything. Preparation of financial statements, compliance with accounting standards, preparing financial statements on an accrual basis, and compliance with Schedule 3, which we will see in detail in the next section, is a requirement of the Companies Act 2013. We also saw that there are some other requirements. Obviously, there are more. We have just covered in a more holistic way. There are more requirements, but there are certain requirements which we would not think of, but are actually flowing from the Companies Act 2013. So this is everything that comes from this act. Is any questions so far? Moving on to the next bit, where we see an overview of Indian accounting standards. So does anyone know what IFRS is? International Financial Reporting Standards. And does anyone know what US GAAP is? What are International Financial Reporting Standards, IFRS, and the US GAAP? Okay, so does anyone know what generally accepted accounting principles are? GAAP. When I say GAAP, what do I mean by when I say generally accepted accounting principles? So, Arav, do you want to take this up? I'm getting correct answers, but this is not completely answering the question. Accounting standards all over the world. So before we move on to what IFRS is, what is US GAAP, what are Indian accounting standards, let's first understand what generally accepted accounting principles are. So when I talk about any two companies, which has two different accountants, and they are preparing their financial statements, and they are not aware of any gap. They don't know about the going concern concept. They don't know about the accrual concept. So what they will do is, everyone has their own perspective. They have their own way of looking at things. So where I am saying that this is a non-cash item, maybe someone is going to say that this is a cash item. So what's going to happen is, if there are no guidelines, no principles in place, two people having their own perspectives, having their own ways of looking at things, are going to prepare the financial statements very differently. So if I am one person who's preparing the financial statements of company A, applying my own logics and my own opinions, I'm going to prepare it in a certain way. And someone else who is preparing the financial statements of company B will also prepare it according to his own opinions, that this is what I think is how the company's financial statements should be prepared. And now what's going to happen is that when I want to, maybe I'm an investor and I want to compare company A and company B, I won't be able to compare them because they haven't been prepared according to the same guidelines. That is, maybe the going concept is not applied, or accrual concept is applied in a very different way, not as per what the Companies Act says or what ICAI says. So that is not being done. When, in the absence of any principles, any guidelines which are laid down by a statute, what is going to happen is that different kinds of financial statements are going to come up and they won't be comparable, which is where the gap comes in, the generally accepted accounting principles, which lays down the guidelines of the principles or the concepts or the conventions on the basis of which the financial statements of a company should be prepared. So when I say IFRS, it's a gap, International Financial Reporting Standards. This is a gap which gives out the guidelines, that these are the guidelines about every line item in your financial statements. And every line item in your financial statements have to be complied with the IFRS. So if a company is IFRS compliant, it has to be complied with the generally accepted accounting principles laid down in IFRS to be comparable with any company which is also IFRS compliant. Again, US GAAP is also a generally accepted accounting principle which is followed by US companies, which lays down its own guidelines and principles, which not be very far away from IFRS, but yes, there are some differences. Again, if I talk about the gap that is followed or was being followed in India for most companies, which was the Indian gap, that was also a gap, a generally accepted accounting principles on the basis of which financial statements in India were being prepared. Now, what happened was that in 2015, and this discussion was actually going on for a long time, if I'm not wrong, it started somewhere around 2010, 2011, that why are Indian companies following Indian GAAP and how do they become comparable with their global counterparts? So, if a company which is a subsidiary in India is preparing its financial statements in accordance with IGAP, and it has its holding company in, say, UK, which is preparing its financial statements according to the IFRS, which is a different gap. So, how do we compare the subsidiary in India with the holding company in UK? So, this is something that was discussed. And in 2015, what happened was that Indian accounting standards, which is also short formed as INDAS, came up. And this was again a gap which was largely converged with IFRS, that is International Financial Reporting Standards. So in 2015, the company's Indian Accounting Standard Rules 2015, which actually are laid down in the Companies Act 2013. Like I said, the Companies Act 2013 lays down the base and everything else follows. So the company's Indian Accounting Standards Rule 2015 laid down the adoption of Indian accounting standards in a phased manner beginning from financial year 16-17. So what do I mean by when I say phased manner? This means that this was not applicable to every company all of a sudden. Some companies were given some sort of leverage that, okay, say you are not falling within this turnover, or you are an unlisted company, or your net worth is this much. So there was a phased manner happened that which said that if you are not falling within those requirements, you don't have to comply with them immediately. That is not from the financial year beginning 2016 and 17, but you have to do this when these requirements get triggered for you. So Indian accounting standards were converged with IFRS. What do I mean by when I say converged? That these were largely similar. That is, the principles, the guidelines, framework, everything that was laid down in Indian accounting standards was largely similar with international financial reporting standards, which are being followed by a lot of countries. So they were largely converged with them. They were largely similar, except a few differences which are identified. So if I talk about property, plant and equipment and our fixed assets, the Indian accounting standard, which is Ind AS 16 for property, plant and equipment, is exactly the same as IFRS 16. So there is no difference there. But if I talk about the business combination standard in Ind AS, that has some differences with IFRS, even intangible assets. So they were largely the same, they were converged, but there were some differences which have been identified and carved out. So by this convergence of Ind AS with IFRS, reporting by Indian companies became globally relevant and comparable. So a subsidiary in India could be compared to its counterpart in UK or in US. The financial statements are being prepared in the same way or following the same principles. So the phased convergence to Ind AS from current GAAP, that is the Indian GAAP. Like I said, that the companies were following Indian GAAP, and even today, a lot of companies are following Indian GAAP in India. So the phased convergence happened on the basis of the net worth. That is, if your net worth exceeds this number, you have to start following Ind AS and the listing status of the entity. So every listed company in India was required to follow Ind AS. So this is something that happened in 2000 financial year 2016, 17, and it's still going on. Still see a lot of companies switching to Indian accounting standards because their requirement has got triggered or they are voluntarily adopting the standards. So this is something that's happening. Any questions so far? I know this got a little finance accounts heavy. So Uncle, you're asking me why can't we have same accounting standards all over the world? Because that's a very that's a very innocent question, but I don't have an answer to that. So every country has its own accounting standards, which are now becoming more or less similar with some differences. But it's not so. If I talk about there's not only IFRS, US GAAP, and Indian accounting standards. There's also the Singapore financial reporting standards, the Australian financial reporting standards. So we can't tell Australia to follow US GAAP. It is a gap that has come up for their country. But I would also like to tell you that most of these financial reporting standards are actually now converged. Like they are mostly similar, except a few differences which are identified. So accounting has become quite easy. If my current client is an Australian company and I have no understanding of Australian financial reporting standards, but I can still work for them because I know Ind AS, I know IFRS. So there is hardly any difference. And if those differences are identified, I just have to learn what those differences are and I'm sorted. So accounting has become a lot easier than what it used to be. Cable is asking, what about the clauses which are not complying with US GAAP and Ind AS? What happened to them after they're identified? Like this would depend upon what the requirement is. Like let me give you 2-3 scenarios. So if say I am someone who knows IFRS, but I don't know what US GAAP says, and I have to give some technical advice to my client, what I'll do is I will pick up that standard in IFRS. I know the clauses there. I know what the standard is saying. Then I pick up the counterpart US GAAP standard. I see what the differences are. And if my advice is falling within those differences, I have to identify those differences. I have to see those respective clauses. And then I have to give advice according to US GAAP. So it's not like it will be very difficult to understand. They can still be understood. So once they are identified, my requirement will shift to US GAAP and it won't be at India's or IFRS. So this would depend on what I am doing. So if say you're an accountant in a IFRS company, like your subsidiary Ind AS and your counterpart, like your holding company is US GAAP, if those differences are identified, then you need to take care of those differences and make sure that financials are being prepared in accordance with US GAAP. That is what the holding company requires. So it would completely depend upon the requirement of the companies. Sahil, you're saying any amendment recently made to companies? Yes, there are actually a lot of amendments. Some that I am aware of are that Schedule 3 has completely changed. That is, the format of presentation of financial statements has become very, very detailed. Like something like ratio analysis, which was not going in financial statements earlier, has to be done now. Another requirement is the major change in CSR. Any other questions? Any questions from the non-finance people? Bharat, you're asking about the formats. Yes, we do. You just have to Google Schedule 3 to Companies Act 2030, and you will get the format either on ICAI or on MCA. It will be there. Like it will be very easy to find. So moving on, did an overview of Companies Act 2013. We also did an overview of Indian accounting standards. We learned what Indian accounting standards are. I have a question again. So if there are two companies, like I said, a lot of companies in India are still following Indian GAAP, which lays down its own framework, its own requirements. And a lot of companies in India are also following Indian accounting standards. So now I'm also saying that Schedule 3 lays down the format for presentation of financial statements. It gives you the guidelines. So can Schedule 3 be used for both Indian GAAP companies and for both IGAP compliant companies and India's compliant companies? Is that possible? Since these are two different gaps, so the presentation would be very different. Arav is saying that Schedule 3 covers both. Yes, you're right, it does. But yes. Okay, so Prakhar got it right. There are separate divisions in Schedule 3. So there is Division 1, which is for Indian GAAP companies. Let's move on to Schedule 3 to the Companies Act 2013. So Schedule 3 to Companies Act 2013 lays down to the format for preparation of financial statements. It gives you the guidelines, the instructions or the guidelines on the basis of which the balance sheet, the statement of profit and loss, the statement of changes in equity, all the components that we just spoke about are prepared. So format for preparation of financial statements is actually given in two divisions. It's been broken down into two divisions. There is Division 1. So companies, IGAP compliant companies or Indian GAAP compliant companies, that is companies who are still preparing their financial statements on the basis of accounting standards. The format is given in Division 1 to Schedule 3. So there are two divisions. First is Division 1, which is for IGAP compliant companies. And the format for preparation of financial statements for Ind AS compliant companies is given in Schedule Division 2 to Schedule 3. So it's broken down. If you Google right now, also if you Google Schedule 3 to Companies Act 2013, you will see two divisions. There is Division 1 and Division 2. There are guidelines laid out for companies complying with ICAP. There are guidelines that have been laid down for companies complying with Ind AS. So if I talk about the most basic difference between these two divisions, which most of you would be aware with, is that in Division 1, which is IGAP compliant companies, the liabilities come first. So we will see equity, liabilities, and assets. And in case of India's compliant companies, which are following Division 2, the assets come first, then we see equity, and then we see liabilities. So this is the most basic difference that you see between these two divisions. Obviously, there are other instructions and guidelines that are given out. So these, the Schedule 3, if you're a company complying with the Companies Act 2013, you have to prepare your financial statements in accordance with Schedule 3, which again is a requirement of Companies Act 2013. So you see, I started with Companies Act 2013 and I still haven't left it because it came into play when I was talking about requirements. It also came into play when I was talking about Indian accounting standards. And also when I'm saying that a company has to prepare its financial statements in accordance with Schedule 3. So any questions so far? Bharat, you're asking me how do we segregate when I've been India's compliant or ICAP? Sorry, I didn't understand your question. So if you're India's compliant, you go to Division 2. If you're IGAP compliant, you go to Division 1. I hope that answered your question. Any other questions? So Bharat, your question is how do we get whether a company has to follow GAAP or India? This would depend upon its net worth. Like what is the net worth of the company? Is it listed or non-listed? So there is this whole framework that comes in. So if your net worth is say more than becoming more than 250 crores in any year, you become Ind AS compliant and you have to prepare your financials in accordance with Ind AS. And before that, you were preparing with IGAP. But also there is voluntary adoption that has come up. So if a company wants to voluntarily adopt Indian accounting standards, it can. So, Prakhar, this is a very interesting question you asked me that if a company is following IGAP, which does not have any guidance on a particular topic and India's has that guidance, can we use that or we can use any other arbitrary manner also? The answer to this is, in my practical experience, that if IGAP, so if I talk about something like share-based payments, so the Indian accounting standards, till very recently, now the guidance note has come, but IGAP actually didn't have any guidance on group share-based payments. So if a company, a holding company of a company is giving its employees ESOPs, then how do we do the accounting? So the IGAP did not have any guidance on this. So in that case, inference could have been drawn and it was drawn from Ind AS, which is what is the requirement is that if there is no particular guidance given in IGAP, you can draw inference from Ind AS for that particular aspect. And it has to be called out in the financial statements of the company that this inference has been drawn from Ind AS or IFRS. That can be done.
I think it was so very well explained. I had so many takeaways from the sessions. Thanks a ton for that. And I'm sure it would have been likewise. And of course, I think everybody was glued to their chat boxes. They were trying to answer and participate. So, proof of the fact that the masterclass was really helpful. So, thank you so much for that.
Thank you.
Great. So of course, for the next couple of seconds and minutes, I would just like to tell you, just like you attended this entire masterclass that was conducted by Tanya. Even though I think we can call her now Professor Tanya itself, right, in a way, but she's a practitioner who's trying to make sure that she is trying to transfer the information which Tanya has gathered across her experience working both at EY as well as KPMG. Now, here we are having KPMG in collaboration with Masters Union is running a program in applied finance where you are going to be having practitioners like Tanya come in and make sure that you get a glimpse of what is there in the high growth industry of finance. And when we're talking about this program, we're currently admitting applications for the second cohort. The first cohort is already active. It started on the 5th of February 2022, and now the second cohort is going to be starting, and we're already accepting applications on a rolling basis for that. So if anybody is having any questions regarding the MasterCamp in Applied Finance, which is going to be in collaboration with KPMG. So please feel free to use the question answers platform, or please feel free to use the doubts platform also. Otherwise, just make sure that, if you're feeling yourself, make yourself very comfortable, try to address any question that you have. I think you're having the best person to answer, because literally a sort of a semi-veteran, because of her age, I'm saying semi-veteran. Okay, so there's a question that I would like to ask Professor Tanya that's put by Jay. Jay is saying, what is the difference between a CA degree and when we're talking about the course which is offered by KPMG and Masters Union in Applied Finance? Would you like to take this forward? Even though like CA is going to be hardcore, much more theoretical in nature, and this is more applied finance, but still, would you like to address this question?
Okay, so if I talk about the curriculum that is covered in CA and if I compare that with the Masters Union curriculum, so CA is actually very extensive. It's very, very vast. It does not cover like accounts and finance, what we are doing here. It also covers aspects like taxation. And it's also like very, very hard to clear. It takes very, very long to do it. It took me 6 years to do it. And yet I think I'm doing what I would have done had I done a course by Masters Union. So it actually breaks down the nitty gritties of CA, tells you about the more relevant aspects, more something that actually will help you when you're working with any company, like maybe a company like KPMG or EY or any other company. And it basically focuses on that, and it doesn't focus on the vast aspect, not taking anything away from CA. I'm a CA too, but it's very, very intensive. And Masters Union will just focus on getting you a job as soon as possible.
Right. There's also a compliment for you amongst a lot of complimentary messages. So Keval is saying thanks a ton for this session. Even though he was not he's coming from a non-finance background, but you made it so lucid. You made it something which is so comprehensive that even he had takeaways. So again, I think with the compliment is also tied that entire expectation that anybody who wants to take up entry-level finance domain jobs can also join this program. So someone who's either in their second or third year of college would be looking to graduate, or anyone with 3 years of work experience and is interested in making a career in the domain of finance can definitely be the apt ideal candidate that we'll have when we're looking at the KPMG run MasterCamp, where we're looking at applied finance altogether. I think there are compliments for you, I must say. Lavangi is also like, it was an amazing session. Genuinely, it was. I think the way that you clarified and the way you took each and every question along, be it so you didn't renounce any question. I loved how you said, oh, that's a very innocent question, that why are there different marks altogether. So I loved that. I think I was hooked. I was sold entirely. So I think thanks a ton for that. Yes, I think everybody is in unison agreeing to the fact. So why don't you only encapsulate, considering I think you'll be the apt person, you're taking the sessions as well. So if you have to encapsulate the spirit of the applied finance program, how would you describe that?
This was like a very short version of that. It's this and more. We'll be covering more topics. We'll be going into more details. I won't just tell you that India is converged. I'll tell you what all Indian accounting standards are there, what are the differences. We'll also be doing Companies Act 2013. There's fraud, trade and regulations. Everything else is there. So this was just like a very like a trailer to what is there to come when we do this course on a wider basis.
Right. Ankit, you don't have to apologize. You saw the spirit with which, I would like to use the epithet professor only right now, because the way that you've taught and there were key learnings, the way that, Tanya walked us through the entire session. So I think all of us were novices when it came to the domain of finance, but it was so comfortable for each one of us to understand those concepts. Kudos to you for that. Thanks a ton. You were also highlighting the fact that, of course, had the course been there for you, your journey would have been simpler. But that, I think, sheer humility. But still, having said that, how does this course irons out a lot of the problems and hiccups people face when they're looking for a job, like in an organization, perhaps like KPMG itself? How would the course really help them drive that sort of placements in organizations like KPMG?
I actually was very surprised to see a question in the chat box where someone asked me that if I am an IGAP company and there is no guidance there, and I come to can I draw an inference from India? I was very surprised to see that question, because that is something that we do practically a lot. So, like when I'm answering your question, this is not something that I learned while studying CA. This is something I learned practically. So what you'll do is that when we are teaching you, we'll like the students also, like kudos to them that they have these practical questions. So we will be answering them. And when you go and get a job, where they would obviously not be throwing questions right from the standard at you where they ask you about the clauses, but they would ask you about the practical applicability. So that is where we help you, and that is what is going to help you get the job, because practical application is something that is way more important than the theoretical knowledge that comes from the standard, which is, I think, very, very highlighted in our course, because everyone who's teaching here has faced these situations practically in real life scenarios. So we take from your questions and we answer them, and that just helps you crack the interviews.
Absolutely. And I loved how you started the session by giving that Gillette example and telling us that how this is a high growth industry that we're talking about. And every day, like you were humble enough to say that, this is something that you learned this morning, but that's clearly showing that how every company is trying to make inroads and trying to access the financial capacity or the capabilities that India has to offer. There's a question which has been asked by Kashish. So Kashish, this is a collaboration. So Masters Union in collaboration with KPMG. So KPMG is Vijay Gogoi, Shubro, they came in together and they saw that, there is, of course, this high growth industry of finance. There are over 2 lakh jobs. If you go on job sites like Monster, Naukri, Indeed, you'll be able to find 2 lakh finance jobs at the moment as we speak. And by 2026, this number is supposed to be swelling to 8 lakh jobs. But when we are talking about companies having that requirement and people who are able to fit in, that is where the gap is lying. We don't have a lot of trained, skilled professional workforces to enter the high growth industry of finance. So that is how Masters Union had collaborated with KPMG to bridge that gap and get people who are practitioners to share their examples, and just not make it a theoretical class, but make sure that, they're coming with their examples, trying to share it. And just like, here it was mentioned, so Tanya had said that this is just like a piecemeal. It's just like a bite of what you would actually be having when you're attending that applied finance class altogether. And the placements are focused over here. So the career services team at Masters Union from the second term itself will start mapping you up, and there'll be a proper outreach calendar where you'll prepare your 5 reach organizations, 5 dream organizations, 5 safe organizations, and then accordingly you'll be moving forward and fast paced with your placements altogether. So it's a placement focused. Your placement support will be provided to ensure that you're entering the high growth industry of finance altogether. Shreyas, we keep on conducting webinars where we exhaustively talk about all the details of the applied finance program. I would really urge you to actually take a look at it, and even on the Masters Union website, everything, all the details, that what you get after you complete the program, how intensive the program is, because it stretches to about 1 year entirely. All the other aspects are clearly categorically mentioned. Today, we wanted to focus on the masterclass that we had. Fiza, you can visit the website, the Masters Union website, and you'll be able to see it in the segment of master camps. There's a KPMG Applied Finance Master Camp. There, all the details would be there. And we'll keep you posted. Considering you got the invite for this particular session, we'll keep you posted for any session that we'll conduct in the future as well. So Harini is asking about summer internships. So here, when you're joining the program, there is of course 5 terms that they're covering across 6 months, and then there is a live project which is given by KPMG. So would you like to elaborate a little on the live project?
The live project is actually not a, like, I won't say it's an internship with KPMG per se. It's more like a virtual internship where we will give you the questions and there will be assignments, there will be projects, and a master trainer from KPMG will be guiding you with every assignment that you do. So it's like a virtual internship where we will be acting as mentors and we will be helping you with your projects and assignments.